Good day, everyone. My name is Michael John A. Del Sol, and I'm going to be your presenter for Capital Structure for BA 910, Financial Management of Ateneo de Davao University. My presentation covers the following topics. First, we have defining capital structure, where we will be able to know the analytical framework used when determining the capital structure. Second, we also have business and financial risk. This is where we can distinguish the difference between business risk from financial risk in running a business. And lastly, we also have the capital structure theory, where we will be able to discuss the capital structure theory and use it to explain why firms in different industries tend to have a different capital structure. Now, moving forward, let's define first what is capital structure. Now, what is capital structure? Capital structure refers to the firm's mix of debt and equity that is used to finance a firm's asset. So, we have here a sample of balance sheet or statement of financial position, which consists of total assets, current and non-current, total liabilities, current and non-current, and shareholders' equity. When we talk about capital structure, it is the particular combination of debt and equity used by a company to finance its overall operations and growth. That comes in the form of bonds, issues, or long-term or even short-term loans that companies borrow from the financial institutions in running or growing the firm. However, it excludes non-investor supplied liabilities such as accruals and payables, while shareholders' equity, on the other hand, may come in the form of common stock, preferred stock, or retained earnings. Just like what we have discussed in the previous chapters, the debt and equity ratio is useful in determining the riskiness of a company's borrowing practices. With that being said, this is where the company's capital structures play a vital role in ensuring the right balance of debt and equity mix in funding the company's overall operations and growth. Now, moving forward, when analyst refers to capital structure, they are most likely referring to a firm's debt-to-equity ratio, which provides insight into how risky a company's borrowing practices are. Usually, a company that is heavily financed by debt has a more aggressive capital structure and therefore poses a greater risk to investors. This risk, however, may be the primary source of the firm's growth. Debt is one of the two main ways a company can raise money in capital markets. Companies benefit from debt because of its tax advantages. Interest payments made as a result of borrowing funds may be tax deductible. That also allows a company's business to retain ownership, unlike equity. Additionally, in times of low interest rates, debt is abundant and easy to access. On the other hand, equity allows outside investors to take partial ownership in the company. Equity is more expensive than debt, especially when the interest rates are low. However, unlike debt, equity does not need to be paid back. This is the benefit to the company in the case of its declining sales. On the other hand, equity represents a claim by the owner of the future earnings of the company. Now, taking all of this into consideration, it's worth reiterating that capital structure plays a very vital role in a firm's growth or decline. With that being said, finding the optimal capital structure is very important for every firm, as it balances the mixture of the cost of debt and equity. Now, what is optimal capital structure? It is a capital structure that is ideal to maximize a firm's stock price. It is useful to analyze the situation and attempt to determine the optimal capital structure, but in reality and in practice of the firms, it is very difficult to do so with so much confidence. As a result, in practice, many managers think of the optimal capital structure more as a range, for example, from 40 to 50% debt, rather than a precise number, for example 45%, which in turn will give the benefit of the maximizing of the stock price. Other firms study the situation, reach a conclusion as to the optimal capital structure. After that, the firms then set a target capital structure. Now, what is target capital structure? It is defined as the mixture of preferred stock and common equity which the firm plans to raise capital, mostly provided or defined by a precise number, as opposed to optimal capital structure, which is normally presented in the form of average or percentage. So when the actual debt ratio is less than the target level of the firm, would raise capital by issuing debt. On the other hand, If debt ratio is higher than the target level, equity would be used. Now, setting the capital structure involves striking a balance between risk and reward, meaning using your debt would raise risk during stockholders, and using more debt normally increases the expected return on equity. Now, moving forward, now in setting target capital structure, the target may change over time as conditions change, but at any given moment, management generally has a specific debt ratio in mind. Setting the capital structure involves a trade-off between risk and return. Now, using more debt will raise the risk borne by stockholders. However, using more debt generally increases the expected return on equity. The higher risk associated with using more debt tends to lower the stock price, but the higher debt-induced expected rate of return raises it. Therefore, we seek to find the capital structure that strikes a balance between risk and return so as to maximize the stock price. Now, there are four factors in capital structure decisions. These are business risk, tax positions, financial flexibility, and managerial conservatism or aggressiveness. Now, what is business risk? Business risk is defined as the riskiness inherent in the firm's operation if it is use no debt. The greater the firm's business risk, the lower its optimal debt ratio. The second factor in capital structure decision is tax position. Now, a major reason for using debt is that interest tax is deductible, which lowers the effective cost of debt. However, if most of a firm's income is already sheltered from taxes by depreciation tax shields or interest on currently outstanding debt or tax loss carry forwards, its tax rate will be low. In this case, additional debt would not be as advantageous as it would be to a firm with higher effective tax rate. The third factor in capital structure decision is financial flexibility, or the ability to raise capital on reasonable terms even under adverse marketing conditions. Corporate treasurers know the steady supply of capital is necessary for a stable operations, which is vital for our long-run success. They also know that when the money is tight in the economy or when a firm is experiencing operating difficulties, it is easier to raise debt than equity capital, and lenders are more willing to accommodate companies with strong balance sheets. Therefore, the firm's potential future need for funds and the consequences of a funds shortage combine to influence its target capital structure. The greater the probability that the capital will be needed, and the worse the consequence of not being able to obtain it, the less debt the firm should have on its balance sheet. The fourth factors in capital structure decisions is managerial conservatism or aggressiveness. Now, some managers are more aggressive than others. Hence, they are more willing to use debt in an effort to boost profits. This factor does not affect the true optimal or value maximizing capital structure, but it does influence the firm's target capital structure. These 4 points or factors are largely determine a firm's target capital structure, but operating conditions can cause its actual capital structure to vary from the target. For example, a company's actual stock price might for some reason be well below the intrinsic value as seen by the management. In this case, management would be reluctant to issue new stock to raise capital, so it might use debt financing even though this would cause the debt ratio to rise above the target level. However, the company would probably take steps to return the capital structure to its target level as soon as the stock price approaches intrinsic value. Now, moving forward, so in the previous slide, we examined risk from the viewpoint of the corporation and we considered how capital budgeting decisions affect the firm's riskiness. Now, we introduced two new dimensions of risk, the business risk and financial risk. Now, let's try to dissect the difference between the two, starting with business risk. Business risk is defined as the riskiness of the firm's asset if no debt is used. These are general risk factors, both internal and external, that affects firms' profitability. Examples of which are financial crisis, economic recessions, labor problems, corporate fraud, product and pricing problems, and operating leverages. Business risk varies from industry to industry and among firms in a given industry. Furthermore, business risk can change over time. For example, For many years, the electric utilities were regarded as having little business risk, but a combination of events in recent years altered the utilities' situations, producing sharp declines in their ROEs and greatly increasing the industry's risk. Today, food processors and healthcare firms are examples of industries with low business risk, while cyclical manufacturing industries such as autos and steel, as well as many small startup companies, are regarded as having especially high business risk. Business risk depends on a number of factors, the more important of which are listed here. First, the demand variability. The more stable the demand for a firm's product, the other things held constant, the lower its business risk. The second factor is sales price variability. Firms whose products are sold in highly volatile markets are exposed to a more business risk than similar firms whose output prices are more stable. The third factor is input cost variability, wherein firms whose input costs are highly uncertain are exposed to a high degree of business risk. The fourth factor is the ability to adjust output prices for change in input cost. Some firms are better able than others to raise their own output prices when input costs rise. The greater the ability to adjust output prices to reflect cost conditions, the lower the degree of business risk. The fifth factor is the ability to develop new products in a timely, cost-effective manner. Firms in high-tech industries such as drugs and computers depend on a constant stream of new products. The faster a firm's products become obsolete, the greater the firm's business risk. Number 6 factor is the foreign risk exposure. Firms that generate a high percentage of earnings overseas are subject to earnings decline due to exchange rate fluctuations. Also, if a firm operates in a politically unstable area, it may be subject to a political risk. The seventh factor is the extent to which costs are fixed, operating leverage. If a high percentage of its costs are fixed and hence do not decline when the demand falls, the firm will be exposed to a relatively high degree of business risk. This factor is called operating leverage, and it is discussed at the length in the next section. Each of those factors is determined partly by the firm's industry's characteristics, but each factor also is controllable to some extent by management. For example, most firms can thorough their marketing policies, take actions to stabilize both unit sales and sales prices. However, this stabilization may require spending a great deal on advertising and/or price concessions to obtain commitments from customers to purchase fixed quantities at fixed prices in the future. On the other hand, financial risk is defined as the additional risk placed on the common stockholders as a result of using debt. Now, if a firm decides to go and use debt or financial leverage, there's an additional risk placed on the stockholders for choosing debt. There could be a potential likelihood of bankruptcy due to exposure, excessive debt, and other financing cost items such as leasing. Now, financial leverage will be discussed thoroughly by my co-presenter on the succeeding topics. The main difference between the two is the additional risk being added on firms in running operations.